That's why I created Jake and Gino. I'm like, there's got to be a better way. And you said something that really stood out to me. Analyze deals and find deals. Most investors out there don't even know what a deal is.
Welcome to the podcast. I'm here with Gino Barbaro. He's a real estate investor, business owner, author, co-founder of Jake and Gino, a multifamily real estate education company. He uses his proprietary framework of buy right, manage right, and finance right, and he's used that to build a portfolio of over 1,400 multifamily units. How you doing, Gino?
Chris, you forgot father of 6, which is very important. Homeschool kids, got an amazing wife, and family and business, they go hand in hand. So let's let it rip today.
Yeah, no, I saw that in your bio. I did not know that about you. You may have shared it in the past, but I did not know. And when I saw that, I was like, do I include that or not? But because that is important. I mean, a family, we've got a family of 2. I'm busy. They keep me really busy. I can only imagine what a family of 6 does for you.
It's great. It's awesome.
All right. Just kicking it right off. When you think of where you're at today, I mean, you've had a lot of success. You've got a huge community, 1,400 multifamily units or more than. Thousands of people are watching or listening to you, whether it's on a podcast forum, YouTube, or attending some of your live events. And then you've got a pretty good community of students that you coach, like one-on-one in a group setting. So when you reflect back to where you came from, like the beginnings prior to real estate, like what do you feel, or how does that make you feel? What do you think about?
The first word that comes to mind from starting the journey is responsibility. I want everyone to write that word down, because without responsibility, you can't take a journey. In 2008, read the book T. Harv Eker, Secrets to the Millionaire Mind. I realized that at the Great Recession, we can either blame the economy, blame Frank Dodd, blame whatever is going on, or we can take a look at ourselves and say, how do I grow? Your income can grow only to the extent that you grow. And I was stuck. I had one restaurant, amazing food, but what was happening in 2008? A lot of competition, a lot of things were changing the economy. All of a sudden, you have Grubhub, you have these other services, you have different eateries coming online, Panera's going hot. It's just different food types. And I was stuck there, and I said, what is my next step? I had done a couple of real estate deals that did not work out for me, and they didn't work out because I wasn't educated. I ultimately took responsibility, and hey, partnerships were bad. The market was bad, but it was my responsibility that those deals didn't work. So that word, everybody, if you're not ultimately responsible for all of your actions today going forward, you're not going to quote unquote succeed. Another book that I would recommend to everybody, I just finished reading it. Dr. Hardy and Dan Sullivan wrote The Gap and the Gain. I want everyone to take a look at where they are in life. We're always trying to achieve or trying to aspire or trying to hit that goal, which is what we should be wanting to do. But don't forget to look back and see the amazing amount of gains that we've already accomplished on that first deal that Jake and I did. If I look back from 2009 meeting Jake to 2013, there was 4 years that I had a relationship with Jake before we bought our first deal. It took us 18 months to find that first deal. If I did not look back and say, wow, I can't believe we got that first deal, all of those actions that I needed to take to underwrite a deal, to talk to brokers, to actually partner up with Jake, to put in the LOI. Always measure your gains and measure your growth by looking back and what you've accomplished. And that will fuel you to go forward, because we all need that vision to go forward. But looking back, it's been an amazing journey. And I'm just, to me, scratching the surface, and my goals have changed. I'm not one here who wants to acquire more units. I'm here to acquire really good deals. That's what my goal is for myself. The Jake and Gino community has closed almost 35,000 units. We only started 4 or 5 years ago. The first couple of years, students weren't closing deals, but it's that momentum, looking back and doing those daily habits and putting those daily grinds and making sure that you're working towards your personal vision and knowing why you're doing it. For me, the big why of getting to multifamily was I had a W-2 job. I didn't want to get on that rat race. How many of you guys out there, by a show of hands, I wish I could see people's hands go up, are stuck in that rat race? I was working. Someday I'd get paid. Even though I was self-employed, I was stuck in that rat race. I wanted to find, quote unquote, some type of passive income. I didn't want to fix and flip homes. I didn't want to buy single family because I needed something that was scalable, that I could do part-time until I knew in my gut that I could say, okay, restaurant, okay, brother, here are the keys. I'm going to do real estate full-time. And for me, multifamily was that vehicle. So that was the starting point for me, Chris.
Love it. And so on responsibility, the book that came to my mind was Extreme Ownership by Jocko Willink. And
Yes.
so it sounds like you've read that too. And just
Yes.
having that humility to realize that there are things outside your control. I mean, you just can't control them. I mean, it just is what it is. But the things that are within your control, just take ownership of it. And then
Mhm.
as you're going, having that ability to reflect back, like even if you're not where you're at today, just know that you can reflect back and look at where you are now based on the decisions you made before and how you've progressed. Like I don't early on, I never really dreamed that I'd be doing podcasts. I don't even know if podcast was a thing back then.
Mm-hmm.
And really, I think I and a lot of other people, they'll get frustrated with, hey, why am I not here? Because this person's there, this person's there, this person
Exactly.
has 500 units. But you look at like for us, we flipped 200 houses. Most people will never flip one.
Mm-hmm.
Or if you flipped 5 houses, again, most people will never even make that first offer. Like just having the
Mm-hmm.
humility and perspective of where you're at and be able
This
to
is
move
why,
forward.
Chris, this is why they need to read that book, The Gap and the Gain, because you're describing exactly what the gap is. The gap is, well, Chris has done 200 homes. I haven't done one. You can't compare yourself to others. All of a sudden, you're in the gap.
Yeah.
The gain is, well, I just started and I've already got a deal in the contract, or I'm already looking at walking deals and I'm going to get a deal. That's the gain. So we are all the time, I would say all the times, but many times we find ourselves in the gap. Let me give you a quick example from the book. You have a child, you give that child 6 spoons. He's happy with the 6 spoons. You take one away, the child has a temper tantrum. He's in the gap, but he has 5 spoons. He didn't have any before. Now he has 5. He's looking for that 6th one. Practice gratitude every day. Be happy that you have 5 spoons. And that's how we are as adults. Don't worry what Chris has done. Don't worry about Gino's resume. It's taken time for us to get there. And if you can worry about what you're doing and focusing on your goals and your aspirations and surrounding yourself with people who will aspire to you, that's what the community is all about that we've created. We have like-minded individuals in there. We're creating multifamily entrepreneurs. You need that accountability. You need that network, especially in real estate. Chris is not flipping 200 homes a year by himself. He's talking to Gino right now. He has other people and other team members doing that. That's the important thing. But you don't just show up and start flipping 200 homes. There's a process that takes place. There is a humility. There's a service. There's a lot of hard work. There's no 4-hour work weeks in the beginning. I still don't have 4-hour work weeks. So I don't know where that idea comes from, because if you love what you're doing, you're not going to work 4 hours a week. You're going to work 40 hours a week minimum, if not more. But it does take time. And read that book, because it's such a powerful book. Because when you show gratitude for what you have, it opens up the possibilities. All of a sudden, you have that positive mindset. You don't have those energy blocks. You have enough uplifting, attitude, and you can do anything. Attitude, behaviors are belief driven. If you can believe it, all of a sudden things start happening in your life.
And just to enjoy the process, because I mean, if you truly hate it, you really shouldn't be doing it. There's plenty of better things to do, and that includes real estate. Like maybe if you hate it, I mean, just passively invest so you can do something that you really like, but enjoying that process, because ultimately, like you said earlier, you're going to grow as much as your personal development and your education allows you to. So that moment that you finally decided, like, real estate's it. Actually, let's skip forward. Multifamily is it. Like so because you mentioned you already decided real estate, but had maybe some road bumps there, but multifamily is the vehicle that's going to get you from A to where you really want to be B. What happened that got you to that moment? Was it circumstance? Was it just an evolution of things, or a culmination of things?
I think a little bit of everything. My first deal in real estate was a mobile home park deal. I would have stayed with mobile home parks if that deal had succeeded, but I didn't have the education. I didn't have the skill set. And I partnered with somebody. The deal went sour. The next deal, I invested in a strip mall, mixed use building. And at the beginning of the Great Recession. So you can imagine how that went for a few years, the pain of the commercial leases and all, investing in New York in a market that I didn't know. So in 2008, I said to myself, I own a fourplex. I love dealing with tenants, residents. I love that model of being able to provide a basic human need. Food, clothing, and apartments. It's a basic human need. It is
never going away.
It's huge demand right now. I was talking to my mom 20 minutes ago. She lives up in New York. She like, can you believe all these apartments they're building? They're going crazy. I said, Mom, you know nothing about demographics, and you know nothing about how much supply there is not on the market. They need to continue to build because we are in an affordable housing shortage. Mm-hmm. They haven't built enough single family homes and people are renting. The demographics show that the millennials and the baby boomers tend to rent. Millennials are having kids later and baby boomers are downsizing, and renting is so affordable. And so here are the keys back after a year. You have all your amenities. You have a gym, you have a clubhouse, you have a dog park washing, you have car washing, you have a pool. Why would you buy a house if you're 30 years old and you're living? It would be insane. So you can see the shift towards that. But for me, I just saw it as a way to provide a great service and to scale up and to do it part-time and to get that economies of scale. Our first deal was a 25 unit deal. So I was still working at the restaurant. Jake was doing his pharmaceutical sales. Our second deal 3 months after that was a 36 unit. So we have 60 units within the first 4 months of our first deal. I can see the writing on the wall and say, wow, one more big deal. And Jake, I'm ready to go off to the races, and you are too. So that was the idea behind multifamily. And really to drill it down for everybody out there who has a single family home portfolio, I'm not hating on it. My only issue with single family homes to scale is very difficult once you get into the 20, 25, 30 single family homes because they're all different. Hot water heaters in a different area. Grass cutting is different. You have 3 bedrooms on one, 2 bedrooms on another, different flooring, different cabinets. When you're buying a 25 unit apartment complex, all 25 units are the same. The maintenance man knows where all the hot water heaters are. The maintenance man knows what kind of sinks you're putting in. It's a much more scalable and controllable model. We're selling time. If you can turn a unit in 5 days as opposed to waiting 25 or 30 days, so much more efficient. And in multifamily, it does lend itself to being able to build a business. You're looking at it when you first start out as diamond mentality. I'm gonna do this and I'm gonna do that. But when you start getting 60, 75 units, you can say to yourself, wow, here's the light at the end of the tunnel. I can start hiring people. I can get a full-time property manager, a full-time maintenance tech. And you have a couple of deals, a 25 unit, a 15 unit, and a 30 unit. You can combine those together. And all of a sudden you've got full-time help. So for me, it was more out of a necessity. I fell into it. I enjoyed it, but I'm like, how do I couldn't see myself flipping 2 or 3 homes a year while I have a full-time job, especially starting out. Swinging a hammer, that whole construction idea of that I couldn't do that, but I could see myself being a landlord and, having 25 tenants under one roof.
Yeah, it was an evolution. I've been watching certain folks I respected in masterminds and just folks that I've networked with move off into other aspects. I think every single one of them started as single family, but they moved off into mobile home parks, self-storage units, and then multifamily. And I would just stay in touch with them. And have conversations. How are things going? Observing while I'm doing my thing. And like for us, it got to a point to like you mentioned, scalability. So we had stopped flipping just because it's a job. And there's nothing wrong with flipping. It's a good way to make money, but it is a lot of work. And at the end of the day, you're selling an asset that you bought it below value, and you're leaving a lot of future intrinsic value. You're removing it from the equation because you don't own it anymore. So we're just like, and then the combination of things like we were talking about with low inventory. If we're gonna work really hard to get a deal, it's got to have more than one door. So that's how we moved into that. Now, so you got your second deal within 4 months of your first deal. I tell folks all the time, like the first deal is always the hardest. And you've got to get in the game. Like you got in the game, start out making offers, analyzing deals at nauseum. And you do that for 6 months. Eventually you're going to spot a good deal. But then it comes down to, you actually have to play the game. You got to buy something. Do you think that, because it took you 18 months to get that first deal, but 4 months to get the second, do you think that's because of that extra field time that you had, game time that you had closing on that first deal? Is that probably what allowed you to now escalate the time and close that other one in 4 months?
There's a couple of thoughts come to mind. Mark Twain's quote, "It ain't what you don't know that will get you in trouble. It's what you know for sure that just ain't so." And what do I mean by that? Everyone listening to this is like, multifamily is a pie in the sky. I could never own an apartment complex. Well, you can become a limited partner for as little as $50,000 in a deal, and you own multifamily. So right there off the bat, crush that limiting belief. Or you could learn how to creatively finance a deal. Our first deal was seller finance. We needed $80,000 total closing costs on a $600,000 asset to get a 25 unit property. I'm sure a lot of the listeners out there know and can get $80,000. And if it's not their money, they'll go out and borrow it from somebody else as well. So the idea was we didn't know what we were doing. We didn't know the multiple ways to get into multifamily. We didn't know how to speak to brokers. We didn't know how to analyze deals properly. We didn't know how to do property tours. We didn't know how to put offers in. And that's why I created Jake and Gino. I'm like, there's got to be a better way. And you said something that really stood out to me. Analyze deals and find deals. Most investors out there don't even know what a deal is, or don't even know how to analyze a deal. Or more importantly, how many of you out there have actually created a criteria for buy rate for yourself? What kind of deals are you looking for? Are you looking for newer assets, older assets? How many units? How much capital do you have? What is your net worth? Do you have investors out there? How long are you going to hold the asset for? What is your exit strategy? All of these questions play into the type of deal you're looking at. So if you're coming to me, I'm looking for deal flow. Well, what type of deal are you looking for? Anything that makes money, cash flow. Let's get a little more granular than that. If you don't know that, it's going to take you 6 years to find a deal. You need to know what works for you, because a deal that works for Gino and one that works for Chris may not work for John or for Mary. Get granular on what you're trying to do. Some markets, you're going to really crush it with capital appreciation in the future, but they may not cash flow for the first 18 months or 24 months. If you're a person who's older and needs some retirement income, you may have to invest in a market that is going to provide a little more cash flow, but a little less capital appreciation. So figure out what you're trying to do. And ultimately, imagine a conveyor belt. We talk about the conveyor belt theory at Jake and Gino. What your goal is to get a deal on that conveyor belt. It's comprised of cash flow and capital appreciation. As you get more assets stacked on the conveyor belt, you're creating a multifamily business so you can replicate this. Those deals start to matriculate. All of a sudden, that equity comes into play 2 or 3 years down the road, and you either sell the asset, you refinance the asset, or you continue to hold it, and that cash flow continues to snowball. That's what I think a lot of a lot of investors don't understand. That's the biggest mistake I think that I made initially on, is I didn't look at every deal as what my exit strategy was going to be. I thought I'm going to buy and hold forever. Well, you know what? You're buying and holding forever. Some of these assets become functionally obsolescent. When you're at a high of the market right now, maybe it's time to take some of that equity off and repurpose it from the conveyor belt and put it into a different asset, maybe a newer property right now. So have that exit strategy cleared out. Know what your buy rate criteria is. Real quick, ours, we want assets 80s and newer, hopefully brick. We love 100 units plus, but we're looking for any deal size, because that's what the smaller deals in this market right now are really crushing it. We're looking for median incomes for at least $50,000 for median income around the property. We love 2 beds, 1.5 baths, townhomes preferably. We like washer dryer hookups in these units, because that's a really big amenity. Mm-hmm. What else are we looking for? I mean, as far as cap rates, you have to go with what the ingoing cap rate is of a market. So in Knoxville, they're 4 to 5 caps. That's what you're looking for in these types of properties. Get granular on what kind of cash on cash returns and debt coverage ratios you need to have. And the reason why I say this is it's all about focus, and pick a market and learn the market. When you're focused on that asset, I send that deal criteria, or I speak to a broker. That broker knows what I'm looking for. He's not going to send me a deal in a D area. He's not going to send me a brand new build. He's not going to waste my time. He's going to send me what I'm looking for. And I am going to look professional. They're not going to ask me for my proof of funds, because they know I'm a player, and it's all about focus. So when that deal comes, all of a sudden you just know it. We're just signing on a deal today. 40 units, 2 beds, 05 build, amazing price, mom and pop. It's just checks every box that we're looking for. And when that popped up, my partner got in the car, drove out there, knew what he was looking for. Didn't even have to underwrite the deal. We know exactly what the numbers are. Once you get really comfortable, you know that the numbers make absolute sense. So you don't have to waste time doing it. So focus on it, but learn that buy rate criteria and start creating one specifically for yourself. Does that make sense?
You touched on something that I tell householders all the time, and it's the concept of return on equity. Mm-hmm. So house flippers or wholesalers or even real estate agents working commission, like it's all good ways to make money, but you miss out on the equity, but you also miss out on the multiplier effect that equity can have. So keeping it simple from a single family standpoint, I've got this whole presentation where if I would have flipped a house, we would have made 10 grand. Mm-hmm. Pretty disappointing flip, because this was needed a lot of work. We're going to make, at the time I recorded that video, $100,000 over 5 years. Mm-hmm. That was assuming appreciation doesn't go crazy like it has been. Well, I actually just double checked the comps, and we've had like an extra we've only owned this house for a little over a year now, and the comps have gone up like an extra 30 grand above and beyond what I've already projected out. So we'll probably end up hitting the 100 grand point by the end of year 4. Same thing with multifamily. So now maybe year 3, maybe we wait to year 5, we pull that out, and then you go and replace that. Not with either you sell it or you refinance and you take the equity. And the multiplier effect is you don't go use it to buy one property, you buy 2.
Yes.
And over a 10-year period, if you want to keep it super, super simple, you can buy a huge multifamily, and that's great. And that is what we're doing. It's what you're doing. But if you want to keep it super simple, just use the same strategy on single family. You can buy 1 a year for 10 years. Boom. You got a multi-million-dollar assets under management. Let your tenants pay them off. Done. If you want to be a little bit more aggressive, starting on year 5, start selling or refinancing maybe one of the weakest, sell the weakest one, the biggest pain, or refinance the one that appreciated much. Take that money, buy 2 more. Now, instead of into 10 years, you've got 15, 20.
It's funny, Chris, you're talking on a linear approach, which is what most people do. But by year 5, after you've bought 5 homes, you're not buying a home a year anymore because you've got enough experience. You've got enough people in your network that you're buying 3 and 4 and 5 homes, and you're adding other assets. I would tell everyone to write these 2 quotes down. They just came to my mind. Transactions pay the bills. Equity makes you rich. Reality. And number 2, it's not what you make, it's what you keep. Multifamily with cost segregation will drop your taxes precipitously if you're doing it.
Greatest wealth preservation tool ever.
Absolutely. And look at all of the wealthy. You have to mirror what the wealthy do. The wealthy look at the tax code and they follow the tax code. It's not hidden. You can go out there. You can see what the tax code is. They utilize the tax code. Responsibility, once again. Why are all these rich people rich? Why are they wealthy? Why am I not doing it? Well, they're following the tax code. I wasn't following the tax code to the law. I wasn't following what the government was allowing for me to do. So that is one of the greatest benefits of what's driving this trend towards multifamily is those cost segregation benefits and the ability for you to have a dividend or a cash flow at the end of every month on top of that, on top of an asset that's appreciating. You're having the principal being paid down by your residents. You have an inflation hedge. There's just so many amazing benefits to it, but it's really ultimately not what you make. It's what you keep. If you're flipping a home, you've got to pay ordinary income because it's in a business at the end of the year. So you're paying a much higher tax rate. Whereas someone who's investing and putting that money into a deal, they're going to pay a much lower tax rate. They're going to keep much more of the money that they make.
Absolutely. Absolutely. So how can investors find their first deal? Like, so in this market,
yes,
which it's a hot market, if it's priced right, even if it's priced aggressively, it's going to go quickly. How can investors looking to get in, large multifamily is a different game. Let's maybe think of the smaller multifamilies. That's most people are probably going to get into the 10, 20, 30, maybe even 50 unit type of properties first.
Our last 3 deals, we closed in a 25 unit back in December. We have a 21 unit contract on the contract right now, and we're putting this 40 unit on there. And there's a recurring theme. These 100 units plus, there's so much money out there. There's so much private equity that is bidding up these prices. And I'm not saying they're going to work in 3 years, but I don't want to buy a deal that is stabilized with bridge debt just because rents are so low, because that's like catching a falling knife. That is sooner or later going to turn real bad and real ugly. I don't want to create that kind of risk. No deal is better than a bad deal. I want every investor to
clarify. So bridge debt, meaning short-term financing.
Short-term financing. So yes, so you can get short-term financing for these big deals, 24 months or 36 months. It's non-recourse, interest rates higher, right? But the problem with that is costs are higher. And what happens if you're getting it now and 24 months from now, interest rates have risen, which they almost will, without a doubt, have to, and you're refining into a higher debt, a higher interest rate, very, very risky. And then you've got to complete all of the work. So for me, that's not the model. These smaller deals, these 30 and 40 units, you have mom and pop investors that are like, I'm in the single family home space. I'm only buying duplexes and quads. Those 30 units, I can't afford that. I can't do that. And then you have private equity saying, well, that's a waste of my time. I'm not going to do 30 or 40 units. So that's where we've been playing. It's really direct to seller has been working on these smaller deals, believe it or not. Other things you need to do, go out to conferences, right? Go out to Jake and Gino events, go out to other people's events that are out there, go to your multifamily meetups, In the market itself, when you're in a market, in our market of Knoxville, we know all the brokers. We've taken them all to lunch. We understand who plays in what space. We have a couple of brokers there who have larger deals and the brokers that have smaller deals. Understand and create relationships with all of them. And then constantly trying to get on all of their lists, their offering memorandums. And when you do see a deal, you need to create rapport with these brokers. They don't want to go out for a cup of coffee. They want to go out and show Chris a deal. Get on the phone and get property tours, even if the deal is horrible, because you never know. Back in 2018, we were in Louisville looking at our first deal. We were trying to syndicate our first deal. These brokers showed us 3 or 4 properties. At the end of the day, they said to Jake, you want to see one more? Jake would be like, great. They knew what we wanted, the mom and pop. That last deal at 5 p.m. was off market, showed us the deal, never came on market. Jake sat there, he saw a nice orange tractor going, this guy cuts his own grass. He wants this price, bam. And that's what happens, creating those relationships with those brokers and getting online. But for any of you out there who are wholesalers or who are in the single family space and do a lot of direct to seller, continue doing that, because there's a big opportunity, I think, in this market for that.
Yeah, it's very interesting on how close knit. I mean, real estate in general, it's a very social industry, but there's not a lot of people in the multifamily space in comparison to single family.
Yes.
And it's funny, I'll talk with someone or I'll drop a name in a conversation with someone who's like, yeah, I know them. They did this and this deal with this investor and this, or, hey, watch out for this guy, or no, you definitely need to call this this broker right here. Anyone that's doing any type of business in the 25 to 50 units, like it goes through him. It's that cohesion or that networking within multifamily I've seen is very strong. Everyone seems to know each other.
Chris, that's a great point. Our 85 unit that we closed last year in April, well, the 25 unit actually asked the 85 unit, how is it doing business with these guys? He said, fantastic. The 21 unit came from the 25 unit. So it's very, I don't want to say the word incestuous, but word gets around. You do what you say and you say what you do, and you follow through on your commitments, and you will have a long game in this space. It's like you said, it's not huge, and people do get around. They do know who the players are in the space.
100%. So what concerns do you have? Well, to preface, you had mentioned, you talked about bridge debt, interest rates right on the wall. I mean, it's going to be going up. To what degree, we don't know. And you talked about bridge. It may have been on your podcast where I heard that, I don't know if it was you or it could have been a different podcast, but the buyer was a little frustrated. He didn't get a deal, and he went back and was like, hey, what type of financing was, the person who got the deal? Like, what kind of financing were they using? And they were using bridge, which allowed them to get a much greater loan to value than what he was using with conventional. And of course allowed him to justify a higher price too. But what concerns do you have about the uncertain economic climate ahead? And how are you preparing to navigate it? What are you telling your coaching students on how they can prepare just to, everything's mitigating risk. So, well, what are you doing to mitigate that uncertainty?
Well, you need to look at the debt markets, because debt is a circulatory engine of the economy. And when you're looking at debt tends to pull back. They tend to deal out debt less. And we just got quoted a deal for 54% loan to value. Agency wanted on this deal. How do you make a deal work like that? I mean, that's what they're doing. They're lending less money. They're taking less risk. So what ends up happening is one or two things. People come in with all that cash. They have less cash on cash day one, 18 months or whatever. And you can see how that affects expectations of investors. So our investors' expectations going to drop. They have been dropping. They will continue to drop. But at some point, prices need to adjust. The sellers right now have this unrealistic expectation of pricing. They've had it for the last 2 or 3 years. The brokers, they're just going to follow the sellers. They're going to try to get them the highest price, which is their job. At some point, when rates start to rise, whether cap rates rise or lower, you're just going to have to pay less for the property, because debt's going to just be a huger component of it. So for me, I'm thinking, and I've been thinking for a while, the only thing that's saved us over the last 18 months is the inflationary aspect of it, and with rents rising and what they've done with COVID. If COVID did not exist and they had not created this artificial bubble where you have so much demand, not enough supply in the economy, it's going to come to a point where, people aren't working. They're going to have to get back to work. And when they get back to work, are they going to have a job? That's the thing. This economy is built upon jobs and built about demand. We have had a lot of demand in a lot of weird sectors. I mean, when did you ever remember in your lifetime, we're in a recession and boat sales of second homes? I mean, all these things that you would think that people would cut out, self-storage, they're through the roof because there's demand for them, and people doing work on their homes is just so upside down and so inverted. So if anybody's out there telling you what they think is going to happen, they've been wrong for the last 2 years, where there was a forbearance tsunami, an eviction tsunami, renters not paying. No one wants to take culpability, and they don't want to because they don't know what's going to happen in the future. For me, it's always sticking to my criteria of buying these really good deals. And Dr. Linneman said in our podcast, Dr. Peter Linneman, if you're going to buy real estate, look at it in terms of decades. You're going to have 2 really good years, 2 crappy years, and 6 years so. That's why with the buy right criteria, this deal we're buying, it's a 05 build. I don't mind holding this for the next 10 years plus because it's not really going to age out. Now, if I'm buying this 21 unit that we're buying, it says 70s build. We're going to go in there. We're going to rehab everything and make everything as new. But we love the area as well. So we don't mind holding this, and we can see ourselves holding this for the next 10 years. Or else our exit strategy would be 3 years. Let's rehab it, finish it up, and flip it out, make a nice profit, move on. But we're vertically integrated. So we're looking for deals that we can hold long-term because we property manage them, we asset manage them, we control the entire process of it. So for me, I'm worried about inflation. I'm worried about rents getting too high where renters can't afford them. That's what I'm worried about. I'm worried about people not having that demand where the economy is going to implode, where there's not enough products being sold. That's my fear. And I'm okay. I mean, I just want everyone out there to worry about their personal debt. Get your personal debt load down. So when you have those payments, you don't have to go to work. You have enough saved up. You have that savings beside you, not working paycheck to paycheck, because that will liberate you. That will give you options. The quality of your life is I think incumbent upon the quality of the options you have. If you can say to yourself, I've got rent covered for the next 6 months, I don't have to go to work because of that, but I want to go to work because of that. That's a much more empowering life. If you have realtors on here that have extra money in the bank and they're saving it, put it into a deal, start investing that money and start creating wealth for yourself. That's what I want people to see right now. And I'm just afraid that, as this economy slows down and people have to go back or they're forced back to work, there may not be jobs for them to go back to work. And I think one last thing is, as you see demographics and people shifting from the blue states to the red states, affordability in these blue states is getting to be unbearable with taxes, with regulation. And unfortunately, they're pushing up asset prices where I live in Florida and where we invest in Tennessee. And that's going to continue because people are going to continue to move. They're going to continue to look for opportunities. And that's where the growth is. If you think about back in the 1850s, it was the reverse, the migration from the south to the north. We're seeing the complete opposite now because of age, because people who are older don't like cold weather. They're moving from the north, whether you're from Illinois, New York, California, Washington, to the south. And you have to keep an eye on that. All the money, all the jobs, all the opportunities, and it's all coming down south. So be very careful where you're selecting markets. Don't look at cap rates. If a cap rate is low, don't discount the market just because of a low cap rate. Low cap rate means there's more growth in the market, there's more opportunity, and that means that there's less risk. That means that residents are probably going to pay their rent in the next 5 years. Don't base things just on a lower high cap rate. Base them based on what the potential of that market looks like in the future as well.
Yeah, it's such a weird environment. You mentioned earlier about the low inventory. So we have 4 million homes roughly shy of where we need to be. It's impossible for us to build that in any short amount of time. And by short, maybe even 5 years. I mean, we're probably, because we don't have this, we don't have the labor. We don't have the financing for the construction companies, and there's just not enough. Now, there may be some pockets and submarkets that are a little different, but by and large, that's been the low inventory problem before COVID.
Yes.
And then when you take half of the market off for a large period of time, where they just decided they're not going to sell, then you have all this demand, which has created a tsunami of appreciation. Good for landlords, not really good for buyers. That hasn't been good, but how's that going to play out? And all this pumping of money and then inflation, and then there are a lot of jobs, but a lot of job openings, but not enough workers, and it's so weird.
Chris,
housing's not going anywhere.
Yeah, what I would say to everybody is you really need to adopt that long-term mindset. Don't think about today or tomorrow. Think about investing in these assets for the long term. That's how
100%.
multifamily investors.
You got to be able to pay for it too, though.
Yes.
Like, so
Yes.
back to the bridge thing, like your bridge, you've got your 36-month bridge loan, and they need you to finance out. An event happens.
Mm-hmm.
I don't think a 2008 is going to happen anytime soon. It's possible, but hey, that happens. You can't refinance out. What is your alternative? Like having those. I mean, those are worst case scenarios. Knowing where you're going to get that money, how are you going to find or be able to refinance? So mitigating those type of risks will help you navigate. But yeah, otherwise, long term, if you hold any property, even the biggest dud, it'll probably be eventually a big pain in the butt.
Yes,
it'll be a pain in the butt. But eventually, worst case scenario, you pay it off and then you sell it. It may not have been the best deal, but time tends to heal bad real estate investments. But if you buy right, then you don't have to worry about those problems.
Yep, exactly.
Okay, so last question before we close this up. What is your next big thing that you're working towards? Your BHAG, big, hairy, audacious goal.
I've written a few down because I don't have just one. I mean, when you sent me this, I was thinking, and I have my vivid vision here. So I just want to hold this up for everybody. Read the book by Cameron Herold, Vivid Vision, because when Chris talks about a BHAG, Jim Collins, Good to Great, owns that slogan. It's not just that one big, hairy, audacious goal. For Jake and Gino, we want to have an NPS score of 85 or greater because we want to become the white glove service of multifamily real estate education. That is what we want to do. But how do we do that? And for me, it's, students have closed over 35,000 units. By the end of the year, I'd like to make that 50,000. So if you do 50,000 units at 50,000 a door average, that's $2.5 billion of multifamily real estate that the community will have pulled down. We have an MM5, our flagship event. We had MM4 last year in October. It had 850. This year in November, I would like to have 1,200 attendees. I think that is a good, big, hairy, audacious goal. We've never eclipsed 1,000. I'd like to donate and have donated 1 million meals by the year 2030 to the Second Harvest Food Bank. Right now, as it stands in 2022, we are at 259,000 meals. So these are the different objectives that when you write down your vivid vision, you'll be able to chunk those down. I love to be able by the end of this year to have 200,000 downloads a month on the podcast. We've got 120,000 right now. And these are things that when you look back 4 years ago, we had 0 meals donated. We're at 260,000 in 4 years. It's putting the plan on paper and actually trying to get people to help you do this. I wish I could take all the credit for this. I can't. I've got an amazing team. You start with one goal, one directive, have one person hired, then the team starts growing. It's for us all about people, systems, and culture. But those are some of the things that I'd like to. And obviously, we have another objective that me and my wife are doing. We have a children's book. So this to me is a passion project. I've written one children's book, me and my wife. It's called The Cannolis Exploded, between kids between 7 and 12 years old. Parents, start the conversation. This book is all about responsibility, and it's great. It's written for young kids. It's colorful. We're coming out with a second book, and Responsible Rhino, Pity Party Pig, or Creative Caterpillar. You can be one of those three in life, or you can be all three. And just having your kids understand that responsibility, when you do lose a job, what happens? Or your bakery blows up because Pity Party Pig forgot to shut off the gas. What do? Pity Party Pig goes out and spends money and he blows money on credit cards. Responsible Rhino sucks it up, and Creative Caterpillar wants to become an entrepreneur. And you go through that journey and that lens, and that's how you start conversations. And ultimately for me, I love talking money. I love talking finance. People, financial intelligence, we can change the world for the better. If you understand finances and you're not a slave to debt and you can take control of your finances, you have those options and life becomes clear, and money is only a tool to be used. I read in Hardy's book, it's amazing. If you have a problem and money can solve it, you don't have a problem. That's what it comes down to. And I just realized this a few weeks ago, and I never thought of it that way. If there's money here, problem solved. So if more of us can share in that and have that abundance mindset and look at money as a problem solver and not as something to hoard and to compete over, what an amazing life. And it starts with teaching our young kids.
Yeah, I love that. I want to pick up some of those for my kids.
Hit me up, Gino@jakeandgino.com. Love to send a couple to you.
Love it. Appreciate it. All right. Closing out, we ask 4 questions. So the first question is, if you could give advice to your 20-year-old self, what would it be?
I love where I am right now, so I don't want to mess it up. So I probably wouldn't want to tell him anything.
There is that dichotomy, that paradox.
For me, if I'm advising a 20-year-old, find out what you love, spend more money than you make, get rid of your instant gratification,
Make more money than you spend, or spend more money than you make.
No, I mean, earn more, spend less than you make. You
right.
You want to have your income. Sorry, you want income more than expenses. I mean, that's the bottom line. Let's not even talk passive income. But when you're in your 20s, don't go for the money. Go for the value and go for the experience. Because by the time you hit your 30s, you're going to have an amazing skill set that people are going to want to pay you for. And always have that investor mindset. Always look to be making earned income and trying to turn that into some type of passive income. That's what the goal is. But when you're younger, just try to grow whatever skills you love, whatever passion you have. Try to grow those skills.
Love it. Love it. What book or books, which maybe is your own, but maybe not, have greatly influenced your life?
No shameless plugs here. I think the book that I've read in the last year and a half, and this is applicable to all real estate investors, especially single family home people, and especially realtors. It's Stephen Covey's 7 Habits of Highly Successful People. Mm-hmm. I mean, come on. I read the book 15 years ago, didn't understand it that well. It didn't really resonate with me. Don't know why. Read it last year. I'm like, where you been my whole life? I mean, start with the end in mind. That's what we all should start doing. Your job is not to start by creating transactions and then ending up your life by having those transactions. It's starting the transactions and turning those transactions into wealth, into equity. I think that's one of the things. Also, you're talking about using your time wisely, those 4 quadrants that he talks about. Well, things that are not urgent but important, those are the things that we should be doing and we're not doing. You know, the relationships, the networking, the property tours, the underwriting of deals. That is such a crucial book. Sharpening the saw, continuing that personal development. I love the book, and I think everyone should read the book.
Yeah, I should probably reread it again. I remember one of the big takeaways is seek first to understand instead of
then to be understood. Yes, excellent.
In the last 5 years, what new belief, behavior, or habit has most improved your life?
I went to life coaching school back in 2016 and become a certified life coach. And for me, I didn't want to become a coach. I just wanted it for personal development. So for anybody out there who's stuck with their why, who's stuck without having the skill to be able to listen to others, who wants to learn how to ask better questions, who wants to have better connections and better relationships, look up life coaching. It's an amazing skill. It will help you in every aspect of your life. It will give you clarity. And we don't have that clarity. When you don't have the clarity, you don't lack the motivation. You lack the clarity. And once you have that clarity, you have that focus, you can, connect with that motivation. So everybody out there, look into life coaching and look into it, not only just to become a life coach, but for that personal development aspect of it.
Yeah, I would imagine too, because I felt this way too, since we started the Invest Agents community and doing coaching calls and stuff like that. You learn so much by doing that. Like, even though you may have more experience than a lot of the folks, it doesn't mean you're necessarily the smartest, but it's that hive effect of learning from everyone. And there's always these unique situations. It's very, very, very rewarding.
Chris, let me ask you a question. Do you find it that when you help somebody out, the impact that you've created for the person, you feel a lot better about your day and about where you're going?
100%. I mean, there's an agent on the team. He has far surpassed anything that I've ever done. Now, and if he's listening, he'll know who it is. He was an Air Force pilot, got cancer. They grounded him. He beat cancer. Government won't let him fly. Thinking of next steps. Got real estate license. Starting to learn investing. This is 3 years ago. So a year and a half into his career, he's finally full time. Now he's 3 years in. He has sold a combined total of $100 million in real estate.
Wow.
Now, I've sold 65 million. I'm kind of happy about that. I think that's all right. $100 million in 3 years. Just insane. But bravo. Like, couldn't be happier for me. And beyond that, he's got 300 plus units that he's partners to some degree, and
that's awesome.
Multifamily and RV park. So love it. It's cool to see that. I mean, I'm gonna do what I do, but happy to learn from folks that are better. And
love that.
How can people reach out to you?
just go to jakeandgino.com. We have our podcast there. I have a show called The Multifamily Zone, which is going to be transitioning to the Julie and Gino show. So for those of you out there that want not just talk about cap rates and cash on cash returns, they want to have that relationship with their spouse better. They want to have the relationship with their kids better. Communication. That's what my wife and I talk about on the phone, on the podcast. We've actually had Dr. Chapman talk about the 5 love languages. We had all of his authors on there, and it's an amazing way to connect with your spouse. And if you're struggling with why does my spouse want to work with me, or I want to pull her into my business, well, we have a lot of shows based on that, because it's really important. It's important to have your spouse on the same page as you. Maybe they don't have to work with you, but you want to know how to get them involved and how to get them inspired and how to have them part of that journey. Because let me tell you something, it is awesome to be able to work with your spouse. If you can figure that out and you can learn how to work together, man, it's a lot of fun.
Love it. Love it. Thank you, Gino. It's been a true pleasure. If I don't connect with you sooner, at least maybe connecting with you are you going to do it in Orlando again?
MM5. Or? I will see you at MM5 in November, Chris, for sure.
Is it going to be in Orlando again?
It's going to be in Orlando. Yes. The Gaylord, same place. Cause they've got a really big ballroom. They've got a great facilities there. So we love it there.
Yeah, we absolutely loved it. It was amazing. So can't wait. Thank you so much.
Thanks, Chris. Appreciate you having me on.
Take care.